What if I told you that the global banking system is sitting on a derivatives time bomb that could detonate at any moment, and silver is the fuse that's about to be lit? Right now, as you're watching this, something extraordinary is happening in the silver market that most people have absolutely no idea about. The physical metal is disappearing from vaults at an alarming rate, while paper contracts continue to multiply like counterfeit currency. And when this house of cards finally collapses, it won't just reshape the precious metals market. It could trigger a systemic failure that makes the financial crisis look like a minor hiccup. Let me show you exactly what's happening behind closed doors at some of the world's largest financial institutions, because what you're about to discover will fundamentally change how you think about wealth preservation and the stability of our entire monetary system. The warning signs are flashing red, and the clock is ticking faster than most people realize. Here's what you need to understand right from the start. Silver isn't just another commodity. It's not like corn or copper or crude oil. Silver occupies this unique position in our financial system where it's simultaneously an industrial metal, a monetary metal, and a strategic resource that's absolutely critical for the green energy transition and technological advancement. And that creates a perfect storm scenario that's never existed before in human history. Think about this for a second. Every single solar panel requires silver. Every electric vehicle needs significantly more silver than a traditional car. 5G infrastructure, medical devices, water purification systems, electronics, batteries, the list goes on and on. Industrial demand for silver has been climbing steadily year after year, and we're now facing the 6th consecutive year of structural supply deficits. That means the world is consuming more silver than it's producing, and those deficits are getting larger, not smaller. But here's where it gets really interesting. While industrial demand is soaring and mine supply is struggling to keep pace, there's this entire shadow market of paper silver that exists on exchanges like the COMEX. And the ratio between paper contracts and actual physical metal available for delivery has reached absolutely absurd levels. We're talking about leverage ratios that would make any risk manager's hair stand on end. Now, before we go deeper into this rabbit hole, I want to make sure you have access to something that could be incredibly valuable for your financial future. I've put together a comprehensive free guide that reveals the saving secrets thousands of American retirees are using right now to protect their hard-earned wealth from exactly the kind of systemic risks we're discussing today. You'll find that guide in the description below. It's completely free, no strings attached, and it could give you insights that your financial advisor probably isn't sharing with you. Grab that while it's fresh in your mind, then come right back, because what I'm about to reveal gets even more critical. So let's talk about what's actually happening at the COMEX, because this is where the story gets absolutely fascinating. The COMEX is the primary exchange where silver futures contracts are traded, and it's supposed to function as a price discovery mechanism for the physical metal. But something very unusual has been occurring recently that's caught the attention of some very sharp market observers. There are 17 non-US banks that have been holding massive short positions in COMEX silver contracts. We're talking about positions representing hundreds of millions of ounces of silver. Now, in a normal market, these short positions would be hedges against physical holdings or legitimate commercial operations. But the data suggests something very different is happening here. These aren't hedges. These are naked short positions, meaning they're selling silver they don't actually have, betting that the price will go down so they can buy it back cheaper and pocket the difference. This strategy works beautifully in a market where supply is abundant and demand is stable. But what happens when the fundamentals flip? What happens when physical demand starts overwhelming available supply and people start demanding actual delivery instead of just rolling their contracts forward? That's when things get very interesting, and that's exactly what we're starting to see unfold right now. Just recently, there was an unusual spike in physical withdrawals from COMEX vaults. Over 3 million ounces were removed in a single day with no offsetting inflows. That's not normal market behavior. That's the kind of activity you see when sophisticated players are getting nervous about counterparty risk and want their metal in their own possession, not sitting in someone else's vault with a paper claim attached to it. And here's the thing that should really make you sit up and pay attention. When you look at the history of commodity markets, every single time you've had this combination of factors, a structural supply deficit, massive paper leverage, and increasing physical demand, it has ended in a price explosion that caught almost everyone off guard. It happened with palladium. It happened with rhodium. And the setup in silver right now is even more extreme than either of those situations. Let me paint you a picture of what this looks like from the perspective of these banks holding those short positions. Imagine you've sold something you don't own, betting the price will fall. But instead of falling, the price starts rising. And not only is it rising, but people are now demanding physical delivery of the thing you sold. So you have two choices. You can either go into the market and buy the physical metal to deliver, which drives the price even higher and locks in your losses. Or you can try to convince people to take cash settlement instead of physical delivery. But what happens when people don't want cash? What happens when they want the actual metal? Because they understand that the paper claims are worth less than the physical asset? That's when you get what's called a short squeeze. And in a market as small as silver, a short squeeze can send prices absolutely parabolic in a very short period of time. Now you might be wondering, why would these banks take on such enormous risk? And that's a great question with a somewhat disturbing answer. For decades, there's been this implicit understanding in the precious metals market that certain large institutions could manage prices through the futures market to prevent them from rising too quickly. This wasn't some conspiracy theory. Multiple banks have actually been fined billions of dollars for precious metals manipulation. 8 major banks paid over $1 billion in settlements for systematically rigging silver and gold prices through spoofing and other illegal trading practices. So we know for a fact that manipulation has occurred. The question is it still occurring? And if so, what happens when the market becomes too big to manipulate? Because that's the situation we're approaching right now. The physical demand is becoming so overwhelming that no amount of paper selling can keep the lid on prices indefinitely. Let's talk about the supply side of this equation, because this is where things get really concerning for anyone holding a short position. Silver mine production has been essentially flat for years. The easy deposits have already been found and mined. Most silver today comes as a byproduct of mining other metals like copper, lead, and zinc. So when those base metal prices are low, silver production actually decreases because it's not economical to run those operations. But even when base metal prices are high, you can't just flip a switch and produce more silver. It takes years to bring a new mine online. You need exploration, permitting, construction, all of which requires massive capital investment and faces increasing environmental and regulatory hurdles. So the supply side is relatively inelastic, meaning it can't respond quickly to price signals. Meanwhile, on the demand side, you have this relentless industrial consumption that's only accelerating. The solar industry alone is projected to consume increasingly massive amounts of silver as countries around the world push for renewable energy. Electric vehicles are becoming mainstream, and each one requires significantly more silver than a traditional internal combustion engine vehicle. The 5G build-out is still in its early stages and will require enormous amounts of silver for infrastructure. And then you have investment demand on top of all that industrial demand. When people start to lose faith in fiat currencies, when they see inflation eroding their purchasing power, when they worry about banking system stability, they turn to precious metals. And silver, being more affordable than gold on a per-ounce basis, becomes very attractive to retail investors who want to own physical metal but don't have tens of thousands of dollars to deploy. So you've got this situation where industrial demand is structural and growing, investment demand is cyclical and can spike dramatically during periods of financial stress, and supply is constrained and can't respond quickly. That's the fundamental setup. But the real accelerant in this situation is the derivatives market and the leverage that's been built up over years of price suppression. Here's something most people don't understand about how the COMEX actually works. When you buy a silver futures contract, you're not buying silver. You're buying a contract that gives you the right to take delivery of silver at a future date. But the vast majority of these contracts never result in physical delivery. They're just rolled forward or cash settled. The exchange counts on this behavior because if everyone actually demanded delivery, there wouldn't be nearly enough physical metal to satisfy all the claims. It's similar to fractional reserve banking. The bank doesn't actually have all the money that's been deposited. They lend most of it out, counting on the fact that not everyone will want their money at the same time. But what happens during a bank run? What happens when everyone shows up demanding their deposits simultaneously? The bank fails because the money isn't there. The The same dynamic can occur in the silver market. If enough contract holders start demanding physical delivery instead of rolling their positions or taking cash settlement, the exchange could face a serious problem. And we're starting to see signs that this shift in behavior is beginning to happen. The unusual withdrawal activity, the tightness in the physical market, the premiums on physical silver coins and bars rising above the spot price. These are all warning signs that the paper and physical markets are starting to disconnect. Now let me tell you about something that happened in the nickel market recently that serves as a perfect case study for what could happen in silver. The London Metal Exchange had to halt trading in nickel and cancel billions of dollars worth of trades because a massive short squeeze was threatening to bankrupt one of the largest participants. The price of nickel had more than doubled in a matter of days, and the exchange literally changed the rules mid-game to prevent a systemic failure. Think about the implications of that. A major global exchange suspended trading and retroactively canceled legitimate trades to protect a participant who had taken on too much risk. What does that tell you about the fragility of these markets? What does it tell you about what happens when the paper market loses touch with physical reality? And here's the thing, the nickel market is much larger and more liquid than the silver market. If a short squeeze could cause that kind of chaos in nickel, imagine what could happen in silver where the market is smaller, the leverage is higher, and the strategic importance is arguably greater given silver's role in the energy transition. Let's talk about what this means for the banking system more broadly, because this isn't just about silver prices. This is about counterparty risk, derivative exposure, and the interconnectedness of the global financial system. When you have major banks holding massive short positions in a commodity that's in structural deficit, you're creating systemic risk. If those positions blow up, it doesn't just hurt the banks. It creates ripple effects throughout the entire financial system. Remember, we live in a world where everything is connected through derivatives. The notional value of the global derivatives market is measured in the hundreds of trillions of dollars. Most of these derivatives are benign hedging instruments, but some represent concentrated bets that can cause catastrophic losses if they go wrong. And precious metals derivatives, while small compared to interest rate or currency derivatives, can still create significant problems because of the leverage involved and the potential for rapid price movements. What happens if a major bank takes a massive loss on silver derivatives? Well, first, they have to mark those positions to market, which means recognizing the loss on their balance sheet. If the loss is large enough, it could impact their capital ratios and trigger regulatory concerns. Other banks that have exposure to that institution might start to worry about counterparty risk and pull back from lending or trading with them. Credit default swap spreads might widen, signaling increased default risk. And in a worst-case scenario, you could see a liquidity crisis develop where banks stop trusting each other and credit markets freeze up. Sound familiar? That's essentially what happened during the financial crisis, except that was triggered by mortgage-backed securities rather than commodity derivatives. But the mechanism is the same. Excessive leverage, concentrated risk, and a loss of confidence in counterparties can create a cascade of failures that spreads throughout the system. Now, I'm not saying that silver derivatives are going to cause the next financial crisis, but I am saying that they represent a potential trigger point that very few people are paying attention to. And in a financial system that's already stretched thin with record debt levels, persistent inflation, geopolitical tensions, and central banks trying to navigate between inflation and recession, it doesn't take much to tip things over the edge. Let's talk about what smart money is doing right now, because that often tells you more than any analysis or prediction. Central banks have been accumulating gold at record levels. Why? Because they understand that in a world of unlimited fiat currency creation, hard assets with no counterparty risk become increasingly valuable. They're diversifying away from dollar reserves and into physical metal that can't be printed or devalued by a central bank decision. But here's what's interesting. While central banks focus primarily on gold, private investors and institutions are increasingly looking at silver. Why? Because silver offers more upside potential, given its smaller market size and dual role as both an industrial and monetary metal. If you believe that precious metals are going to appreciate significantly, silver gives you more leverage to that thesis than gold does. And we're seeing this play out in the physical market. Retail demand for silver coins and bars has been extremely strong. Premiums over spot price have been elevated, indicating tight supply in the retail channel. Large investors are taking delivery of physical metal from exchanges rather than holding paper claims. These are all signs that sophisticated players are positioning for something significant. Speaking of positioning for what's ahead, if you're sitting on retirement savings and you're concerned about the kind of systemic risks we're discussing, you might want to explore how physical precious metals can fit into your retirement strategy. I've put together a comprehensive guide on gold IRAs that explains exactly how you can get physical gold and silver into your retirement account without triggering tax penalties. It's particularly relevant if you have over $100,000 in retirement savings and you're looking for ways to hedge against market volatility, currency devaluation, and the kind of banking system stress we've been talking about. You'll find that guide in the description. It covers everything you need to know about the process, the benefits, and the potential pitfalls to avoid. Worth checking out if this is relevant to your situation. Now let's talk about the technical picture in silver, because the charts are telling a very interesting story right now. Silver has been in a consolidation pattern, building energy for the next major move. When you look at the long-term chart, you can see that silver has been forming what technical analysts call a cup and handle pattern, which is typically a very bullish formation that precedes significant upside moves. But more importantly than any specific chart pattern, what you're seeing is a market that's coiling tighter and tighter. Volatility has been compressed, open interest has been building, and the physical market is showing signs of stress. This is the kind of setup that often precedes explosive moves in either direction. But given the fundamental backdrop we've discussed, the path of least resistance appears to be significantly higher. Think about what would happen if silver breaks out to new highs. You'd see momentum traders pile in, adding fuel to the fire. You'd see short covering from those banks we talked about earlier, which would accelerate the move higher. You'd see retail investors who've been sitting on the sidelines suddenly develop FOMO and rush to buy. And you'd see industrial users who've been managing their inventory suddenly panic about securing future supply and start building stockpiles. This is how markets work. They don't move in straight lines. They build pressure, consolidate, and then release that energy in rapid moves that catch most people off guard. And the longer the consolidation, the more powerful the eventual breakout tends to be. Silver has been consolidating for years now, building one of the longest bases in its history. When this breaks, it could be spectacular. Let me tell you about what happened during the last major silver squeeze. The Hunt brothers famously tried to corner the silver market back in the late 70s and early 80s. They accumulated massive physical positions and drove the price from single digits to nearly $50 an ounce. Now their attempt ultimately failed because the exchange changed the rules, raised margin requirements, and made it impossible for them to maintain their positions. But here's what's different about the current situation. This isn't about one or two individuals trying to manipulate the market. This is about fundamental supply and demand dynamics that no exchange rule change can fix. You can't create silver out of thin air. You can't change the fact that industrial demand is growing while mine supply is constrained. You can't alter the reality that years of price suppression have discouraged investment in new production capacity. These are structural issues that will take years to resolve, and in the meantime, the pressure continues to build. And here's something that should really concern anyone holding a short position in silver. Unlike the Hunt brothers situation, where the shorts could wait them out and force liquidation through rule changes, the current buyers are often taking physical delivery and holding for the long term. They're not leveraged speculators who can be forced out through margin calls. They're strategic buyers who understand the fundamentals and are willing to hold through volatility. When you combine patient, well-capitalized buyers on the long side with leveraged, potentially desperate shorts on the other side, you create the conditions for a historic short squeeze. And the thing about short squeezes is that they feed on themselves. As the price rises, shorts are forced to cover, which drives the price higher, which forces more shorts to cover, creating a feedback loop that can send prices vertical in a very short period of time. Now, let's talk about the geopolitical dimension of this, because silver isn't just a financial asset. It's a strategic resource that's critical for national security, technological advancement, and energy independence. Countries around the world are waking up to the fact that supply chains matter, that resource security matters, and that being dependent on other nations for critical materials is a vulnerability. We've seen this play out with rare earth elements, where China's dominance of the supply chain has created serious concerns in Western capitals. We're seeing it with lithium and cobalt for battery production, and we're starting to see it with silver as well. Countries that want to build out solar infrastructure, that want to manufacture electric vehicles, that want to develop advanced electronics and defense systems, they need silver, and they need reliable access to it. This is creating a new dynamic in the silver market, where governments and sovereign wealth funds are starting to think about strategic stockpiling. If you're a country that's committed to a green energy transition, do you want to be at the mercy of spot market prices and potential supply disruptions? Or do you want to secure your supply now while prices are still relatively reasonable? The answer seems obvious, and we're starting to see evidence of this kind of strategic buying. But here's the problem. The silver market is tiny compared to other commodity markets. The entire annual mine production of silver is worth less than what some individual tech companies spend on stock buybacks in a single quarter. So when you have governments, sovereign wealth funds, and large institutions all trying to secure physical supply at the same time, there simply isn't enough to go around at current prices. Something has to give, and that something is price. Let's talk about what a real supply crisis in silver would look like, because I think most people underestimate how quickly things could deteriorate. Imagine you're a manufacturer who uses silver in your production process. Maybe you make solar panels or medical devices or electronics. You've been managing your inventory lean because that's what modern, just-in-time supply chain management dictates. You buy what you need when you need it, minimizing carrying costs and capital tied up in inventory. But then you start hearing rumors about supply tightness. You see prices starting to tick higher. You read about unusual withdrawal activity from exchange warehouses. What do? Well, if you're smart, you start building inventory. You secure your supply for the next 6 months, maybe the next year. You're willing to pay a premium over spot price to ensure you can keep your production lines running. Now multiply that behavior across thousands of industrial users around the world, all simultaneously trying to secure supply. What happens to the available inventory? It gets absorbed very quickly. What happens to prices? They spike. And what happens to those banks holding massive short positions? They face a choice between financial ruin or default. This is the scenario that keeps risk managers up at night. It's not some theoretical possibility. It's a very real risk that's growing more acute as the supply deficit persists and physical demand continues to strengthen. And the scary part is that once this process starts, it's very difficult to stop. You can't just produce more silver overnight. You can't convince industrial users to stop buying when their business depends on securing supply. And you can't force long holders to sell when they understand the fundamental picture. Let me share something with you that I find absolutely fascinating. If you look at the gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, you'll see that it's been extremely elevated by historical standards. There have been periods where this ratio has spiked even higher during times of extreme stress, but the long-term average is much lower than where we are now. What this tells you is that silver is historically cheap relative to gold. Now you might say, well, maybe that's justified because silver has more industrial uses and is more economically sensitive. But here's the counter-argument. Those industrial uses create structural demand that doesn't exist for gold. And in a world that's transitioning to green energy and advanced technology, that industrial demand is only going to grow. So you have an asset that's historically undervalued relative to its monetary metal cousin, that has growing industrial demand, that's in structural supply deficit, and that's the target of what appears to be significant short selling by major banks. Does that sound like a good risk-reward setup to you? Because it certainly does to a growing number of sophisticated investors. Now I want to address something that skeptics often bring up. They say, if silver is such a great investment, why hasn't it already gone up? Why has it been range-bound for so long? And that's actually a great question that deserves a thoughtful answer. The reality is that markets can remain irrational longer than you can remain solvent, as the famous saying goes. Just because something is fundamentally undervalued doesn't mean it will appreciate immediately. Markets are driven by sentiment, liquidity, positioning, and 1,000 other factors in the short term. But over the long term, fundamentals always win. Always. Think about what happened with uranium. That market was in a structural deficit for years. Prices stayed depressed because financial players were selling paper contracts and utilities were drawing down inventories rather than buying in the spot market. But eventually, the physical reality caught up with the paper market. Inventories got depleted, production couldn't meet demand, and prices exploded higher. The same pattern has played out in numerous commodity markets throughout history. Silver is following a similar script. The paper market has kept a lid on prices through futures selling and derivative positioning. But the physical market is tightening, inventories are declining, and at some point, the paper tail won't be able to wag the physical dog anymore. When that inflection point arrives, the repricing could be swift and dramatic.